Now, how would Islamic finance handle things differently? Using the $5 billion example, Islamic banks could provide $5 billion of financing for infrastructure, literacy, healthcare, or sanitation programs, to name a few. An Islamic bank could have arranged for the $4 billion construction of a natural gas pipeline and delivered it to Nigeria for $5 billion using an istisna. Or taken an equity stake in a highway project and shared in profits and losses using musharaka or mudaraba. Or purchased commodities and sold them at a premium using a murabaha. Or structured a project financing using an ijara sukuk. These names may sound new to you, but as we explain them in our training modules, they're much like conventional equity, trade, and lease-based instruments already familiar to most bankers. Islamic finance, after all, permits legitimate profit. We're not asking that everything be changed. Just the harmful parts, and eliminating interest would be the first step. In all of these cases, the bank could not have charged more than the initial financing premium. So if the Islamic bank was owed $5 billion, that could never turn into $44 billion or even $6 billion. The debt would have to be fixed. Throughout our training modules, we'll show you how these and other Islamic finance products operate. Let's take another example of how Islamic finance is different from conventional finance. This time, let's make it a little bit more relevant to our day-to-day lives. Nick the home buyer. In 2009, Nick lost his job, his house, and all the money he had spent paying off his mortgage. The property bubble that triggered the global financial meltdown could not have happened if the properties had been financed Islamically. Why? Because a conventional bank merely lends out cash. Legally, it can keep lending this cash over and over, well above its actual cash reserves. An Islamic bank, on the other hand, has to take direct ownership of an actual asset, whether for a longer period in a lease or partnership, or a shorter period in a sale or trade. Islamic finance always limits the institution to an actual asset. The next time anyone wonders whether Islamic banking is just dressed up conventional banking, ask them to show you a single major consumer bank that co-owns actual properties with their customers. Of course, there's no excuse for Islamic banks that are Islamic in name only. But if the transaction complies with internationally recognized standards like AOFI, for instance, then there's no reason for it to have the many side effects associated with interest-based banking. To provide just one example of how Islamic banks get directly involved in asset purchases, let's look at how a diminishing musharaka works. The word musharaka refers to a partnership in Islamic finance. And it's called a diminishing musharaka because the bank's equity keeps decreasing throughout the tenor of the financing, while the client's ownership keeps increasing through a series of equity purchases. Eventually, the client becomes the sole owner. If Nick had lost his job with a diminishing musharaka, at the very least, he would still have an equity stake in an actual property that he could monetize. Pay close attention to this example because this is something you may want to suggest to your own local bank. There's no reason why they can't do it. We've kept all the numbers and calculations very simple and straightforward for illustration purposes. Let's take a $220,000 house. And let's say the customer puts down $20,000 and finances the remaining $200,000 from the Islamic bank. Let's also say that the financing lasts 20 years and the bank sets a 5% profit rate. For the sake of simplicity, we'll make it 20 annual repayments. In the first column we have the year. In the second column, we have the home buyer's equity purchase, which is how much the buyer pays every year for buying the property's actual equity. It's his way of increasing his ownership in the property, while diminishing the bank's ownership, shown in the third column. The fourth column, called rent, is what the home buyer pays the bank for that portion of the property he doesn't yet own, a number that keeps decreasing as the bank's share also decreases. The final column shows what the home buyer pays in total every year. Let's explain to you how we got these numbers and how simple it is for most banks to put this together with just the will to take real ownership of an asset. Let's go through each column one by one. The home buyer's equity purchase of $10,000 is a simple straight-line calculation of the $200,000 divided by the number of years for the financing, 20 years. We subtract this $10,000 each year from the bank's total balance to get the next column, the bank's ownership, which, as we see, keeps going down each year until the bank owns none of the property. Next, we calculate the home buyer's rent. This is equal to the bank's ownership for that period multiplied by the bank's profit rate. This number also keeps declining each year because as the bank's ownership declines, so does the home buyer's rent. Lastly, we calculate the home buyer's total annual payment. This is simply the home buyer's equity purchase plus his rent. This number also keeps declining each year until the home buyer eventually becomes the home owner. At no time does the home buyer pay any interest, and certainly at no time does any payment compound. The home buyer just pays for two things: the house in small payments, little by little, and the rent for the portion of the house he doesn't yet own. This simple structure is something that just about any conventional bank can offer today. It takes a leap of faith for banks accustomed to all-cash, interest-based lending to suddenly become direct stakeholders in property. But as the growth of Islamic banking shows, these concerns are misplaced. Call it Islamic finance, ethical finance, or conventional finance. When a bank takes real ownership of an asset, economies don't fall apart like a house of cards. Now our final example. Talking about indebted countries and property bubbles may seem removed from our immediate predicament. What are we talking about? That's right, personal debt. In the US alone, credit card holders have amassed over $1 trillion of personal debt. And that's just credit cards. Let's take Faisal's student loan, for example. His American university cost him about $30,000 a year for 4 years. That's $120,000. And Faisal had no savings to start off with. He got an interest rate of 10%, which is fairly typical for many students, and he began borrowing $30,000 at the beginning of each year. 3 years after graduation, he began paying off his student loans at the rate of $20,000 per year. Can you guess how long it took Faisal to pay off his entire loan? That's right, it'll take him over 25 years to pay off his loan. And in the end, he spends over $400,000 to pay for his $120,000 education. And that's assuming Faisal keeps his well-paying job. If he's unemployed, the debt just gets bigger. An Islamic bank, on the other hand, could structure a service-based ijara to lease out the university's credit hours. Faisal ends up paying about 20% or 30% more. But with the interest-based loan, he pays about 400% more. Islamic finance never can and never will be able to grow Faisal's debt once it's fixed.